So you finally earn some money, you saved up, now you want to invest into the markets. You want to start off investing in ETFs because it attracts a basket of companies and it's more stable and secure. But here's the thing now, there's expensive ETFs and there's also lower price ETFs that uses a strategy of called the cover call options. But before we get into this, let's talk about what cover call options are. Cover call options are, for example, an investor who owns like 100 shares of Google. They want to write an option that allows the buyer of someone else to buy these 100 shares at a strike price, at a certain price once it hits. But in order to have this right to buy, the buyer themselves will have to pay a premium. Once the strike price is hit, then the 100 shares goes to the buyer, and this investor themselves who was the one who written up the cover call, they'll get the premiums. But for example, if the option itself expires because it has a certain time period before an option isn't effective, or if it can't reaches the strike price at a given time period, then that's worthless. Then the person who wrote the option, they can keep the premiums, but the buyer would not be able to buy these shares at that strike price because it never was executed at that point. So that leaves the difference between, do you invest in long term or do you want to have monthly yields that are like higher for your dividends? If you're typically young, you have like, let's say 10-15 years, you definitely want to invest exponentially with a higher aggressive growth rate, but then you want to buy SPY. But if you want to have something like a monthly income that has a higher yield because of these cover call options that pay the investor premiums, which raises the level of like income for them so they can distribute higher yields of like dividends for their shareholders, then you want to go with SPY, which is also a cheaper price. If you invest in SPY, then you are technically tracking 100% of the S&P 500. So anything happens, like if it's like a bull market, then you will have 100% of like the track rate, versus if you're using cover call ETFs, those ETFs tend to have a upside cap. So you're sacrificing capital appreciation because it only is every strike price, right? So if it strikes but the market goes above that strike price by a little bit, then technically you're losing out on some profit gains. So in terms of volatility, traditional ETFs actually have a higher volatility because it tracks the indexes very accurately, versus a cover call ETF. It's more based on how an option functions. So if the market trades sideways, this ETF will thrive on that, because for an option to execute, it needs to hit the strike price. So if it trades sideways, the execution probability is a lot lower, meaning the investor can collect premiums and can retain their underlying shares. And during market downturn, it also thrives with this kind of ETF, because during downturn, a lot of investors would buy calls, and these premiums tend to get more expensive because they buy these calls in theory that there will be a market recovery. Keep in mind that also the cover call ETFs, that if you were to choose, they have a higher management fee compared to the regular standard traditional ETF. At the end of the day, there really is no right or wrong whether you buy cover call ETFs or traditional ETFs. It really depends on the investor's preference. Anyways, I hope this makes a little more sense for you guys. If you guys like these videos, please leave a like and follow for more.